So we have some exceptionally good news, and that is that a deal has reportedly been approved by Speaker Kevin McCarthy and President Biden himself. So in today's video, and again, if you are interested in the most important news of the entire week, then you need to watch this entire video, because today we are going to discuss an increase in benefits. We're going to talk about new inflation worries. We're also going to talk about breaking news regarding the debt ceiling negotiations. So if you want to know about all this stuff, then this is the one video that you need to watch. And just so you know, not all of this is bad news. Now, before I get into the news for today, can you do me a favor? It just takes 2 seconds. Can you go ahead and hit the like button? And hit that like button if you like getting the most up-to-date news in just one place. And now, let's begin. So first, Kevin McCarthy, the Speaker of the House, and President Biden, they're on the verge of striking a deal over the U.S. debt ceiling. This is great news. This is big news. This is what we've been covering for the past, pretty much for the past month. But over the past week or so, many experts didn't expect the U.S. would default on its debts. Nobody expected this because the outcome would have been much worse. We knew lawmakers would come to an agreement at some point. It just depended on what is the deal going to look like. Well, good news, we're now starting to see what this deal will look like, and I want to break that down for you today. So according to CNBC, Bloomberg, and Reuters, they're all saying that the two sides have tentatively agreed and approve of the deal that is in place. However, they're still not releasing all the information just yet because there are some details that they haven't actually gone over. So, good news is it's getting closer. Now we are about 6 days away from this default date, according to the Treasury Secretary Janet Yellen. However, some say that we are going to take the next 3 or 4 days, finalize this deal, and then vote on this possibly on Tuesday. Well, on Tuesday, that is Tuesday, May 30th. So we might fix this about 2 days before the debt ceiling actually becomes an issue. All right, so good news there. Now, let's talk about quick little, kind of what's happening. So here's what's in the agreement so far. First off, federal spending would roll back in 2024 to current year levels. Okay, Republicans wanted federal spending to roll back to 2022 levels. Democrats said no, that is not going to happen because that would mean massive cuts. And that would have been cuts to veterans benefits, that would have been cuts to Social Security Administration, that would have been cuts to SNAP benefits, that would have been cuts to affordable housing, and the list goes on and on and on. The good news is we are now going to see the levels stay the same. So Social Security Administration is not going to see their funding roll back. We're not going to see it roll back for SNAP benefits. We're not going to see it roll back for affordable housing. All this stuff is going to stay at current 2023 levels. Okay? Here's another big one. Except for federal spending and veterans benefits. Okay? Federal military spending and veterans benefits, those are going to see a 3% increase. Okay? This is where we are seeing additional benefits. Okay? Because guess what? Military spending is something that we can't just, get away from. We have to continue to spend. We don't need to spend more, but we have to continue to spend, and we have to address inflation, which inflation is still over 4%. So yes, military spending and veterans benefits are going to see an increase for next year. They're not staying at current levels. So for all veterans, that means you're not going to see cuts. That's some good news there. Another big piece of this is what's going on with the IRS spending. I talked about this just the other day, and I told you that Republicans and Democrats were on the verge of an agreement which would have meant 25% of the $80 billion that was given to the IRS. Well, they were saying that 25% or $20 billion was going to be rescinded, pulled back. and that money would end up covering a shortfall in domestic spending. Well, the $20 billion didn't get agreed on. So far, the agreement is $10 billion. $10 billion is going to get rescinded, come back, and that money would cover the shortfall for domestic spending. We do not know about COVID funding yet. That is still something that's on the table, being worked out. It's a possibility that some of that money gets clawed back as well. Whether it's the full amount that's still sitting there not being used, I don't think that's going to be the case. I think there will likely be a percentage. Chances are it's going to be anywhere between $5 and $10 billion that will be clawed back. And again, more of that money is going to be used to cover the shortfall in domestic spending as well. One of the big pieces of negotiation, though, was how long this debt ceiling would actually be raised. Is it going to be a short-term one, 6 months? Is it going to be a little bit longer, still short-term, and only a year? That was what was on the table. That's exactly what the House GOP proposed and passed. But Democrats have so far agreed that no, 1 year is not enough. We have to push it past the 2024 presidential election, so it needs to be at least 2 years. As of right now, it is looking like the debt ceiling is going to be raised for an additional 2 years. So we would not have to deal with that until possibly 2025. So that's some good news there. Now, this is all extremely important to get passed, okay? As not passing a bill to raise the U.S. debt ceiling would be catastrophic for our entire economy, be catastrophic for the entire world. It would be a disaster. But there's also some other news that came out today that we also need to address, and that has to do with the key inflation gauge. Okay, so I want to address that for a second, because again, even though this debt ceiling issue is extremely important, this is still half of the battle, okay, or more than half the battle. We have to get this fixed. But here's a new worry, is new inflation. And again, I bring this up because the new numbers that came out today were from the PCE report. This is the Personal Consumption Expenditures Price Index. This measures goods and services, and it adjusts for consumer behavior. But here's the thing. This new report shows that the PCE rose by 0.4% for the month. This is excluding food and energy. Okay? This was higher than the 0.3% estimate. And on an annual basis, the PCE index increased by 4.7%, which is again 0.1% higher than what was expected. Now, when you include food and energy, and this is where the numbers get a little bit tricky, and this is where the Fed is probably going to be worried. The headline PCE rose by 0.4%, but the new inflation is shown by the yearly number, which came in at 4.4%. Probably think 4.4%, that's less than our current inflation number, right? But back in March, this number was 4.2%. So it was 4.2% in March. Now it came in at 4.4%. That's 0.2% higher. That shows inflation. That shows a turnaround. That's not what we need to see. Here's another problem. The report also showed that spending increased by 0.8% and personal income increased by 0.4% month over month. Both of these numbers were expected to increase by 0.4%. So obviously, with spending increasing by double what was anticipated, that's not good news. Again, that shows that we are continuing to spend and that the Fed might not have done enough to pretty much dissuade you from spending some of your money. But the problem with all of these numbers is that they show new inflation. And this could have the Fed a little bit worried that spending is still continuing in a time when the Fed is considering a possible rate hike pause. So keep that in mind. This is a new issue. Even though the debt ceiling crisis, and again, I'm bringing this up because of this this is what experts are anticipating. This is what economists are projecting in the future. As economists are saying that once this debt ceiling crisis is resolved, there's a good chance that the American people feel that, okay, things are okay, we're doing fine, we can then go and spend because we averted this debt ceiling crisis. If that's the case, and we are already seeing in the PCE report that there is additional spending, it's coming in at double what they were anticipating, guess what? That could mean new inflation worries. And if this happens, there's a good chance in the next Fed meeting, they raise rates by another 25 basis points. Not because they need to, okay, because the economy isn't, seeing a slowdown, but it's because we continue to spend. So, we're going to see what happens, but I just wanted to fill you in on everything that's going on. Yes, it is good news that these benefits could potentially increase. This new inflation, it's a major worry, but there are some things that we can do to potentially slow this down. And the U.S. debt ceiling crisis might not be a crisis after all. We may be getting very close to this deal because, again, the majority of the deal has already been approved. But that's what we know at this time. As always, thank you guys for watching. Consider subscribing, and I'll see you guys on the next one.